Good afternoon. I'm Chris Chelius, part of the Option Ranger Development Group. Welcome to the Option Ranger Buying Dow Jones Puts for Bearish Direction with Rising Volatility. For an important disclosure, please be aware that trading stock options, futures, and options on futures involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. And our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends in All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. And without further delay, welcome to our Buying Dow Jones Puts for Bearish Direction with Rising Volatility. And Mr. Mueller.
Thank you, Chris. It's a pleasure to be with all of you. Today is April 3rd, and we are going to be doing a program today on the different classes of options that can be used in purchasing puts. So today's program is on purchasing puts, the advantages and disadvantages of the strategy, the circumstances when it should be done, as well as the various factors to consider when considering a particular transaction. So let's begin first and foremost with our strategy gallery to look at the basic ingredients for the purchaser of a put option. First of all, as we indicated previously, the directional outlook for purchasing a put option is a bearish outlook. So purchasing a put is first and foremost a bearish trade with an anticipation that the market is going to go down. However, equally important and essential to a decision making about purchasing a put is the volatility outlook for that particular market or option. So in addition to an expectation of a falling market, that expectation should be accompanied by an outlook for rising or increasing volatility. And that is because when we look at the particulars of purchasing a put option, which we will see in a moment, it is insufficient for the market to go down unless it goes down sufficiently to overcome the premium and the time erosion of the trade. So let's have a look again at some particulars on a long put. As we indicated, this is a directional trade. It is looking for a down market. The illustration here shows that the market must drop. You see these are diminishing numbers. Must drop down sufficiently to overcome the premium paid for that option. Market must drop enough to overcome the premium paid, and that is why it requires rising volatility. The more deep out of the money options are that are purchased, the more bearish the strategy, and also the more of a long shot it is, as it has to overcome a large move and premium. Why do people buy puts? Well, on the profit side, there's an unlimited profit potential, and once the market overcomes the premium and transaction costs of buying the put, the increases are unlimited, and no matter how much the market drops, obviously there's a floor at zero for any market, and practically speaking perhaps above in markets depending on that market's fundamentals. One of the principal reasons why people purchase a put is that the risk profile or loss profile on the purchase of a put is limited, as it is when purchasing any call or put option outright, or a trade that is strictly long premium, the loss is limited to the amount that is paid for the option, and that is inclusive of the premium and fees, which are defined in the option ranger when we make the inputs. Time decay, or the passage of time, is an enemy of this position because it is a wasting asset. If the drop that was expected does not occur, and it does not occur with the rising volatility, as we indicated, then the value of the option decreases. And as time passes, if a drop with rising volatility does not occur, the option continues to decay in value, and if not offset, and if it's out of the money, then the entire premium that was, the entire cost of the transaction is at risk, but not more, as indicated in the limited risk description. At the bottom, we have an indication with a definition of a put option in this particular scenario, and as we are developing further and further, a demo that you can watch. It's a video, it's a short video on how to input a put option trade into the option ranger in order to get a readout of the risk and reward scenario, as well as the break-evens on premium and on the underlying instrument. Today we'll be doing an example on the Dow Jones Industrial Average. So the person who would be looking at this trade can look at all of the various particulars of the market, have a quick glance at a chart, as well as look at an extensive list of factors to monitor while in a trade, as well as factors to consider before entering a trade. The sections in red are highlighted because they take us directly to the primary sources on these relevant factors. The items in black are items that we update as needed through our various informational resources and daily distribution of our futures facts report. Let's go ahead now and proceed. In this particular scenario, a person is looking for a drop for a variety of reasons, looking at the list. Perhaps they're concerned about the budget deficits. Maybe they think energy prices will inflate. Maybe they think the Treasury is going to create problems, or perhaps unemployment statistics are going to pop up. Whatever the reasoning of the person, this particular person who looks at these variables or perhaps looks at charts has developed an opinion that the market is going to drop, and that it's going to drop with rising volatility. The bigger the volatility, the more explosive the drop, the better it is for the person who is the purchaser of Dow Jones options. And now we're here in the basic option ranger, and we are looking at the, we have the bullish trades that we saw previously listed in here. And as you can see, for illustration purposes, just a couple of days ago, we did the opposite outlook of a purchaser of a put. We showed the outlook for the buyer of calls who are looking in the opposite direction. They're looking to the upside for rising volatility. So these illustrations are not so much to come up with a particular market outlook as they are in order to demonstrate the impact of movements and the impacts of time erosion on various classes of options. Now we're going to go ahead and look at some examples to see intrinsically and premium-wise how somebody wants to speculate on a drop in the Dow Jones would select a trade. And we have already preset the trades in the tabs to save some time. Of course, you can enter your own trades and your own strike prices using the demos and instructional materials provided. So here, as you can see, we have a Dow Jones contract. When you click on the contract, a small dialog box appears to help you out, and that box, if you need additional details, one click away are the contract specs that we viewed previously on the contract, so you can always find your way intuitively from one screen to the next. The strategy that we have here is buying a put. We have input default costs for that transaction and use some prices. Again, these are not necessarily to the minute prices. They're for illustration purposes. The market presently on the Dow Jones is around 16,495, 96. So in this particular case, the first option that shows to be purchased is a 16,450, which is kind of close to the money, not quite at the money option. And for illustration purposes, again, when we click on the strike, if you, for instance, did not know how to enter a strike price and you just clicked on the box, the dialog box appears giving you the particulars on how to list the strike price. And this will also take you to a more extensive discussion of strike prices, including a discussion of different classes of options, which we'll discuss, as well as an option reference sheet that can give you the handy reference to the particulars of calls and puts, and our volatility section that defines different classes of options and provides some demo videos. So let's go ahead and look at our master combination calculator now. So again, the strike price example has a Learn More tab that goes with it, and when you input the premium as well, you get a friendly dialog box here that helps you input the values if you want to do it yourself, as well as an additional button that discusses premium so that you can review everything one click away. And let's have a look now at the trade. We paid 34.9 points. Hit the calculate button. As you know, you can email this trade to a friend if you want a second opinion or you think you have a good idea. You can print it in case you like to take a hard copy of something and scribble on it and look at it, something I myself enjoy. You can save it under a tab, as we did in this case, so you can organize your trades, or you can post it to our monitored forum where any participant can comment on the trade, maybe suggest some changes, and of course, since it is a monitored forum, one of the people in our group will also comment as warranted on anything in the forum. If you find anything that's inaccurate or in the form of questionable advertising, we will be sure to redact it off the site. Now, let's have a quick look here. The particulars on buying a Dow Jones put at 16,450 at 34.9 points. Translated very simply into dollars and cents is a premium paid of $3,490. To have the right but not the obligation to sell the Dow Jones contract at 16,450. And of course, we factor in a transaction cost, which creates your total debit on the trade of $35.45. As in the case of buying a put or even buying a call, where it's a non-margin long premium trade, the net debit that was initially paid, as you can see, is also identical to the maximum risk or loss potential. So as we indicated before in the strategy gallery, the maximum risk on the trade is limited to the net debit on the trade consisting of premium and transaction costs. So $35.45 in this scenario is the maximum possible loss on the trade. That is assuming that the buyer of this option does not offset earlier than expiration in order either to have gains, break even, or perhaps mitigate losses at some level between the $34.90 paid in premium and zero. As with all trades, it's good to have an exit strategy. So now we see the particulars again, a quick reminder of the tick values so that the math makes sense if we have to have a handy look at it. This is the way to remember and to retain information. And now we see also in this key box the numbers that matter. Number one, the premium break-even point. The premium break-even point is the value that is quoted. The premium is the value that is quoted all the time on these particular options as they trade. So if you can sell this option for more than 35.45, for every dollar that you are above that number, since one option unit is 100, every dollar means 100. So for every so if you're at 36.45, you're up $1, that's 100, and so on, and that's what the spreadsheet will reflect. Likewise, if you're down $1 for every dollar that this particular premium is down, there's a loss of $100. One of the key purposes of the option ranger is also to illustrate the one fact, the one objective fact that we have in terms of what the market needs to do by expiration. And that is, where is the futures break even? How far does the futures have to go so that this option has value not just in terms of volatility, which is a variable, but what is it actually worth? And the closer you get to expiration, the greater the certainty. And at expiration, if you will, when there's no volatility or time premium left, or theta, if you will, left in this option, that's when we're actually going to know intrinsically, as closer to a certain number, how much the option will be worth. So at expiration, and using futures intrinsic value, as you can see, the break-even point, let's go back to it, is 16,414.55. 16,414.55. So if a person feels that the market is going to drop there quickly as a premium play, or go well under that number with rising volatility, that would be a justification for speculating on this particular trade, along with the fact that although a premium in time erosion has been paid and time erosion is a factor, the risk, as you can see, is limited. So if this person who is bearish direction with rising volatility is mistaken, then as you can see, no matter how high the market goes, contrary to this particular set of expectations, the maximum loss continues to be no more than the $35.45 that was paid for the option. So in this particular scenario, if a person who's bearish thinks this market is going to drop hard, if they are mistaken, one of the advantages of buying a put option is that, as you can see, the risk is limited even if there is no offset or exit prior to expiration. On the upside, once the premium costs have been overcome and this person is looking for rising volatility on a pretty significant drop, which is what they need, as you can see, the numbers increase by $100 per dollar once the intrinsic value is attained, once the futures proceeds below the break-even point. And as you can see here, you can model out a large move, and you can see where the sweet spot is. The bigger the drop, the sweeter the sweet spot. And by the way, if let's say somebody was looking at this and saying, oh, I think the market's going to drop below 16,280, let me see how much that will mean, and then all you need to do is increase the number of fields so that perhaps you're expecting a larger standard deviation or a larger move. So let's say we go to 70 rows instead of 40, and you can generate a new calculation, which may include the fact that this person saying, well, I think this market's going it's going to 16,150. So then, as you can see here, for a big drop, and actually we're talking from current levels, a drop of about 400 points, 16,150, 16,450, let's call it 300 points, and as you can see, the move is pretty significant on a large drop. So clearly, buying this particular put would suit the purposes of somebody who's looking for a large drop with rising volatility. This option is an at-the-money option. Let's have a look at the next person, and let's say this particular individual is looking for an option that is slightly farther out of the money. I'm going to want another quote on the 16,900 put in a minute, but for now, let's go ahead and look at the 1,600 put. And the numbers will change. This particular put, now the 1,600 put is out of the money. The last put that we saw was an at-the-money put. Again, we have the wording and the explanation for defining such puts and calls. And we also have illustrations for in, at, and out of the money options so that you can view them, in this case, on a chart. And as you can see, the first option was at the money. It was close to the current price. This has changed, but that's where an at the money option is, which is where the market is in the case of a put. If a put is in the money, which we'll look at later, that means it's above the market, so it has an intrinsic value. And any so-called out-of-the-money option means that it has no in-the-money value. Everything it has in it is volatility and time value. And if the market doesn't drop with rising volatility through that out-of-the-money option, since it consists of only time value, at expiration that option would be worthless. So people should be very mindful of how they select the price, strike price, by determining the extent of move. I'd say the farther out of the money one purchases, the greater the move that is required in order for that option to have a chance to become profitable. An at-the-money option may require a smaller move, but will require a larger cash outlay. And an in-the-money put will require, in all likelihood, the smallest move, but will require an even larger cash outlay, because that option is purchasing in the money value. So that if somebody has the right but not the obligation to buy that option, if that option is already intrinsic or in the money, then that value is paid for when the option is purchased, in addition to the volatility value of that option. So let's go back to our master combination calculator, and we are looking at the second example. This is a little bit different. Again, as you know, the examples pop up in the dialog box. In this case, we are purchasing a put. We are inputting all the values. Again, this is a 1600 put, so this put is out of the money because it's below the market. So the market, to get intrinsic, has to work its way down past 1600. The premium paid here is 23.1, and again, as you can see, because it's an out-of-the-money option, it's farther out of the money, it costs less money. So that's always attractive, spend less, but let's see what disadvantages, if any, there are, and what a person should keep in mind when using this out-of-the-money option rather than an at or in-the-money option. In this case, as we can see, the outlay was 2310 instead of, and again, you can always click back and forth between trades. As you can see, it's 2310 instead of 3490. So it's an out-of-the-money purchase, but there's less money spent up front, so that is one reason why a person might choose to purchase this option. But let's have an additional look. We factor in the costs, and again, as you know, when you purchase this option, your maximum cost at this strike on that structure would be $23.65, and as before, when one buys an option, a put or a call, the maximum loss is limited to the total cost of the transaction, which is premium and transaction costs, which are obviously listed and forced inputs in the software so you get the right number. This $23.65 translates into $23.65, and you see here why, because it's $100 per tick. So if this position is $23.65 times 100, a unit option of 100, that's how we come up with the $2,365. When monitoring this trade, that is the premium break-even point and should be followed all the time. If a person can sell this option for more than $23.65, they're making money. If they're selling it for less than $23.65, they're losing money in accordance with a tick value and as will be reflected on the sheet. So one factor, being volatility, is monitored all the time in the premium. It is taken out in our table at expiration and for intrinsic value, so we get a clear difference of what this option will need to do over that period of time in order to also have a break-even on the underlying contract and to help inform the decision of whether or not to offset early. So now our break-even, as you can see, is 15,976.35. So the break-even on premium is lower, but obviously we require a bigger move. And let's see on futures break-even. Let's compare the break-even on this one, 15,976.35, to the break-even on the other. And as you can see here, the break-even that we have is at 1641. So the position that costs less money to buy and less risk total on the trade has a break-even that is at a much lower level on the futures, and by expiration, intrinsically, the market would have to make a larger drop in order to hit its futures break-even. In the case of the option that we were looking at, which was the 1600 put, the break-even is, as you can see here, quite a bit lower, and the numbers look very different on the profit scenario. First and foremost, let's look at the risk level. As we indicated before, no matter how high the market goes and how mistaken this purchaser of a put is, the maximum risk is limited to the $23.65 that was spent initially to purchase the option. At expiration, if this option is out of the money and it hasn't been offset previously, it will be worthless and the entire transaction costs will have been lost. On the other hand, if this person is correct and the market drops, makes a large drop with rising volatility, as you can see, once it goes past the break-even, and now it has to be under 16,000, so it's a lower break-even, the numbers begin to rise, and as you will see, if you just click back and forth between the two trades, it will take a larger drop for this position to gain, and the need for that larger drop is accounted for in part by the fact that it takes a smaller premium to buy into it, because the farther out of the money option is, the greater the move required and the greater the long shot or handicap that has to be overcome. And now let's go ahead and have a look at so we looked first at around an at-the-money option. We've looked at the in-the-money option on the put, and finally we're going to go ahead and look at a 16,900.
Yeah, sorry, that put should be 57.
I'm sorry?
The premium on the 16,900 should be 57.
57?
Yeah.
Okay, now this is the great thing about the software. Whether something changes or you want to try different strike prices, you don't have to input all these things for every change. Although the dialog boxes are right there to help you out, as well as the additional one-click links for this program, which is intended primarily as an educational and analysis tool, especially as to intrinsic value and time erosion that most people don't understand. So in this particular case, all we have to do is change this premium to 55?
57.
57. Okay, let's change it to 57. And as you can see here, we can just go ahead and hit the calculate button. And there we are. The new trade has just appeared at the bottom here of our, we're working many trades. It's always good to keep a history, and then you get rid of the ones that you, that you don't like. And let's go ahead and have a look at that trade. And we can always save it under a tab if we want to keep looking at it. And let's check the particulars. In this particular scenario, again, we purchased one Dow Jones put at 16.9. Okay, so this option is $5,700, which is 57 times 100, which is the tick value, is 5,700. The math is done here, so it's everything. It continues to be translated into dollars and cents. Everything should be broken down and clear. Then, of course, you factor in transaction costs. The transaction cost here is higher because this option, as we indicated before, is an in-the-money option because it's above the market, which means that a portion of that value is intrinsic. It's in the money, and time erosion will not affect it. So, however, the volatility value will be subject to time erosion. So here the total outlay is $57.55, and as we indicated before, when buying a put option, the maximum risk is limited to the total cost of the initial purchase, in this case $57.55. In premium points, again, using the factor of 100, which is the tick value, it means that it's 57.55 to break even. 57.55 to break even, and as you can see here, 16,842 is the level that the market has go to, so it's much closer than the previous level. in terms of a futures break even. And of course, the premium cost is greater in order to have a portion of that option be in the money. And now let's have a look at it. And so the futures break even is there, the premium break even is there. And let's have a quick look at how this looks on a spreadsheet. And as you can see, if the market is strong and goes up, 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 it stays up, it's very aggressively up. The maximum loss on the position is 57.55, which is the total cost of purchasing the option, inclusive of commission and fees on a drop. However, as you can see, once the option becomes intrinsic and overcomes its break-even point, the gains can be fairly significant. And again, it's an unlimited profit profile past the break-even point, and the maximum loss on the upside, no matter how much you adjust these tables, is limited to that amount. Do you have any questions?
No, not now, Mr. Mueller.
That's outstanding. I want to congratulate everybody who is taking the time and effort to learn about the markets. Please feel free to contact us with any questions about these trades or any others, and we'll be happy to model some things out to illustrate the practical elements of using the software. Everybody have a great day, and we'll be in touch soon.
Thank you very much.